Today we're looking at how to know when it's time to sell your stocks. If you've ever wondered whether to hold or let go, I'll walk you through the key signs to know what the right decision would be in any situation. When I first started investing, deciding when to sell was one of the hardest choices I faced. I'd hold onto stocks too long, watching profits disappear, or sell too early and regret it when the price kept climbing. It felt like a constant struggle between holding on or selling. But over time, I learned that there are clear signs and strategies to help make the right decision. And that's exactly what I'm going to share with you today. You'll walk away with a clear framework for knowing when it's time to sell, no matter the situation. The first sign that it's time to sell your stocks is when the fundamentals of the company change. This is critical because if the business itself is no longer performing well, it's usually a sign that the stock price will follow. Fundamentals are the core financial health of a company, and these include things like revenue growth, profit margins, earnings reports, debt levels, and cash flow. When these start deteriorating, it's a signal that something may be wrong, and it's time to pay close attention. The stock's price may not immediately start changing, but may signal future weakness. For example, let's say a company has been consistently growing its earnings for years, but suddenly reports a decline in profits for 2 or 3 consecutive quarters. This is a major red flag. While one bad quarter might not be cause for panic, a pattern of poor earnings could indicate deeper issues that need to be addressed. If you ignore these warning signs, you could risk holding onto a stock that's heading for trouble. But it's not just about the numbers. You also need to consider the management. A change in leadership can drastically affect a company's future. If there's a sudden departure of key executives, or if the company hires a new CEO with a questionable track record, that can introduce uncertainty. Even more concerning is when a company shifts its strategy without clear reasons or alignment with its strengths. If the leadership team is making moves that seem disconnected from the company's core mission, it could signal a deeper problem. A management change can also lead to cultural shifts within the company that hurt productivity, creativity, and ultimately profits. Another crucial factor is the industry. Sometimes, the problem isn't internal, but related to changes in the broader industry. For example, think about the retail sector over the past decade. Companies that didn't adapt to the rise of e-commerce struggled, or even went bankrupt. Similarly, if you're holding a company in an industry that's in decline, like traditional energy, and there's a major push for renewable energy sources, that shift can severely impact a company's growth potential. A company that once thrived in a booming industry may no longer have the same competitive edge as new technologies or consumer preferences change. If the industry outlook turns negative, even the best companies might struggle to maintain profitability. Now, let's talk about what happens with the stock price when these fundamental shifts occur. A stock that has been steadily increasing in price might begin to reverse direction and head downward. This is a clear indication that something is affecting the market's perception of the company's future. If the price breaks below key support levels or dips below its moving average, this is a signal that investor sentiment is shifting. This could be due to negative earnings reports, changes in leadership, or industry-wide issues. When this happens, the stock may continue to slide, and if you don't act, you could end up holding on to a stock that has significantly underperformed. Another situation to consider selling is when the broader market, like the Nasdaq or S&P 500, begins to turn downward. During a market correction or bear market, even strong companies can see their stock prices decline sharply. If this coincides with weakening fundamentals in the stock you're holding, such as slowing revenue growth or shrinking profits, it may be a sign that the risks outweigh the potential rewards. In such cases, selling could help protect your portfolio from larger losses as the market continues to drop. The key takeaway here is to not let emotions cloud your judgment. You should be robotic in your trades, doing what the situation requires, but also human at the same time. More like a cyborg, I would say, as you need to use your judgment when exiting trades. Be firm in your rules, but not rigid. Just remember when using your judgment to base your decision on facts and not on your emotions. Second sign that it's time to sell your stocks is when you've reached your financial goal. This might sound simple, but it's surprisingly difficult for many investors because of the emotional pull to hold on and see how much further the stock can go. Let me explain why sticking to your goals is so important. When you buy a stock, you should always have a clear plan in mind. This includes knowing the price target or percentage gain you're aiming for. For instance, you might have bought a stock at $50 with the goal of selling it at $75 for a 50% return. If the stock reaches that target, selling locks in the profit you originally planned for. However, many investors hesitate at this point. They see the stock continuing to rise and decide to hold on, thinking, what if it goes even higher? This mindset can lead to trouble if the stock price suddenly reverses and your hard-earned gains disappear. It's important to remember that the market can be unpredictable, and no one can consistently time the top. Trying to squeeze every last bit of profit from a stock often results in unnecessary risk. Instead, sticking to your original plan ensures that you capture the returns you set out to achieve. Selling when you reach your goal isn't about missing out. It's about exercising discipline and following your investment strategy. But what if the stock keeps going up after you sell? This is one of the most common fears among investors, and it's understandable. It's frustrating to watch a stock you sold continue to climb. But here's the thing. Investing isn't about capturing every single dollar of upside. It's about achieving your financial goals and managing risk effectively. If you've reached your target and made a solid profit, that's a success. Focusing on what you've gained, rather than what you might have missed, is key to staying grounded in your strategy. Now, there's a way to handle this situation if you feel reluctant to sell everything at once. You can consider selling part of your position. For example, if you own 100 shares of a stock and it hits your target price, you could sell 50 shares to lock in some profits while keeping the other 50 invested. This approach gives you the best of both worlds. You reduce your risk by taking some money off the table, but you also leave room to participate in further gains if the stock continues to rise. This kind of balanced approach can help you avoid the emotional tug-of-war that comes with making a sell decision. It's also worth revisiting your goals periodically to ensure they align with your current financial situation. Maybe your initial target was based on a short-term gain, but now you're thinking about longer-term growth. In that case, you might adjust your plan to reflect your updated objectives. However, any changes should be deliberate and well thought out, not just reactions to short-term market movements. The key is to stay proactive, not reactive. Reaching your goal is a moment to celebrate, not second-guess. It means your investment strategy worked and you achieved the outcome you planned for. By selling at this point, you're taking control of your portfolio and making decisions based on logic rather than emotion. Remember, the purpose of investing is to meet your financial goals, not to chase every possible gain. The third sign that it's time to sell your stocks is when you need to rebalance your portfolio. This is a critical part of maintaining a healthy, diversified investment strategy and protecting yourself against unnecessary risks. Let me explain how this works and why it's so important. Rebalancing your portfolio means adjusting the allocation of your investments to ensure they align with your original goals and risk tolerance. Over time, certain stocks or sectors in your portfolio may outperform others, causing your asset mix to shift. For example, let's say your goal was to have 60% of your portfolio in stocks and 40% in bonds. If the stock market has had a strong run, that balance might shift to 70% stocks and only 30% bonds. While this might look great on paper, it also means you're now taking on more risk than you initially intended. Another scenario where rebalancing is crucial is when you're heavily invested in a single sector, like technology. Tech stocks often experience rapid growth during favorable market conditions, which can lead to an outsized portion of your portfolio being concentrated in this sector. For example, if you started with 20% of your portfolio in tech, but after a strong rally, it's now closer to 50%, you're significantly exposed to the risks of that sector. If the tech sector suddenly comes under pressure due to rising interest rates, regulatory changes, or slowing innovation, the impact on your portfolio could be severe. Rebalancing in this case would involve selling some of your tech holdings and reallocating the funds to other sectors or asset classes, helping to spread out your risk. Rebalancing also helps you prepare for market volatility. Different asset classes, like stocks, bonds, and real estate, perform differently depending on market conditions. For example, during a market downturn, bonds or other defensive assets may hold their value better than stocks. By regularly rebalancing, you ensure that your portfolio remains diversified and well prepared for changing market conditions. This can help smooth out returns and reduce the overall risk of your investments. It's also worth mentioning that rebalancing can be a good time to evaluate the long-term prospects of your investments. When you're deciding which stocks to sell, consider whether the fundamentals of those companies still align with your goals. If not, selling them as part of your rebalancing strategy can serve a dual purpose, reducing risk and ensuring your portfolio is filled with high-quality investments. So, how often should you rebalance? Many investors choose to do it once a year, while others prefer quarterly or even semi-annual reviews. The key is to stick to a schedule that works for you and aligns with your investment strategy. You can also rebalance when your portfolio drifts too far from your target allocation. For example, if your target for stocks is 60%, but they've grown to 70%, that might be a good time to take action. Rebalancing your portfolio isn't just about numbers. It's about staying true to your investment plan. Selling overperforming stocks may seem counterintuitive at first, but it's one of the most effective ways to manage risk and ensure that your portfolio remains aligned with your financial goals. By doing this regularly, you're taking a proactive approach to protecting your wealth and setting yourself up for long-term success. Before knowing when to sell, it's crucial to know what to buy. In my video, How to Pick the Right Stocks, I'll guide you through spotting winners and building a strong portfolio. Don't forget to like, subscribe, and hit the notification bell so you never miss out on more valuable stock tips. Click on the screen now to keep growing your investing knowledge, and I'll see you in the next one.